With the S&P 500 hitting all-time highs, you may now be wondering, should I sell now? Wait for the market to come back down? Then I buy back in again? After all, if you look at some of the indicators, many of them seem to be flashing a sell signal. The S&P 500 Shiller PE ratio is now showing that it's getting overvalued again. Same for the Buffett indicator, which is getting close to the 2000 dot-com bubble valuation. Meanwhile, a recession might just be around the corner, with one analyst even warning that we will see the biggest crash of our lifetime in 2024. So, in this video, we will look at whether we should sell now when it's at all-time high, or is it better to continue investing no matter what. But before I start, do join my Telegram chat group, which has over 7,000 members now, where you can discuss or ask any questions that you may have. Alright, let's jump right in. Conventional wisdom tells us that we should never chase high prices, and that we should always buy low and sell high. But ever since the S&P 500 found its bottom back in 2022, it has been going up ever since, and has delivered a stunning 35% return. But how much further can it go? To answer that, let's first look at historical data to see how the S&P 500 usually performs after hitting all-time highs. Check this out. Here, we compare what would happen if you only invest at all-time highs versus investing at any other time. What we found was that from 1950 to 2020, while only buying at all-time high gave lower returns as compared to the other strategy, the difference in returns is only a tiny 1%, whether it's for a 1-year period, 3-year period, or 5-year period. Take note that during this time, we have been through some of the worst times in history. For example, we have been through 2 huge lost decades where the market basically gave zero returns for more than 10 years. Then, there were super bad events such as World War II, 1970s Great Inflation, 1987 Black Monday, 2000 dot-com bubble, 2008 Great Financial Crisis, and so on. And yet, there still isn't much difference between buying at all-time highs versus buying at any other time. Here's another chart by JP Morgan which looks at the same thing, but this time, the period is only between 1988 to 2020. This time, investing at all-time highs actually produces better returns. Not only that, the difference in returns is more than the 1% that we saw earlier. Like for the 3-year period, buying at all-time highs outperformed buying at any other time by 11.3%. But how is this possible? I thought there were some really bad crashes during these periods, like the 2020 COVID crash where the market fell by 34%, or the 2000 dot-com bubble where the market crashed by 49% and took almost 3 years to recover. Shouldn't buying at all-time highs give you much worse off returns than buying at any other time? As it turns out, whenever the S&P 500 reaches an all-time high, there's a very low chance of it going down by more than 10%. In fact, the longer the time horizon, the lower the chance. For example, if we look at the 1-year period, there's only a 6.5% chance of the market going down by more than 10%. 3-year period, only a tiny 1.6% chance. And 5-year period, 0% chance. Basically, the market be like stonks. According to Bloomberg, the S&P 500 index has hit 1,176 all-time highs since 1957. So that's about 17 all-time highs every year on average. Obviously, there are some years such as during 2022 where the market be like wee going down and we don't see any all-time highs that year. But what this tells us is that all-time highs are really common. Check this out. This chart shows the number of days between all-time highs. So if you ignore the big triangles and focus on the tiny triangles near the bottom, you will see that all-time highs happen very frequently. Here's another chart which shows the same thing. The red dot is whenever the market has hit an all-time high. What you will notice is that all-time highs usually happen one after the other. This is also true whether we are looking at developed markets or emerging markets. All-time highs usually cluster together.
One like that,
As the author describes it, this is how markets work. When more dollars are trying to get into an asset than are trying to get out, prices rise. And if this behavior continues, prices will continue to rise. Higher prices attract more buyers, which attracts higher prices, etc. Or to put it simply, everyone just wants to FOMO whenever they see the stock going up. And now, a word from today's sponsor, Webull. With Webull's Money Bull, you can now earn a 5.4% 7-day yield on your US dollar and 3.8% 7-day yield on your Sing dollar. But first, what even is Money Bull? In short, Money Bull is Webull's cash management tool that lets you earn a return on your money. They do it by investing your idle cash into money market funds. Moneyboo gives you more flexibility as it helps you better optimize the utility of your idle cash. What this means is that you can continue trading even when your funds are in Moneyboo. That's because 99% of the market value of your Moneyboo position will be added to your buying power, and the funds from your Moneyboo position will be auto-redeemed when you need more cash to settle your trades. Automatic subscriptions and redemptions will be processed in the morning during Singapore business days. Besides that, the funds are highly liquid as you can quickly redeem your funds and withdraw your money from Moneyboo within one business day, as long as the redemption orders are submitted before 11 AM Singapore time on business days. And best of all, Weeboo doesn't charge any fee for using Moneyboo, so whatever return that you have earned is yours to keep. Currently, Weeboo is running an attractive Moneyboo promotion, which lets you earn up to $3,000 in cash vouchers by subscribing to at least $2,000 in Moneyboo and fulfilling the requirements. To enjoy this promo, you first need to enable the Moneyboo feature. So first, head over to Menu, Settings, Manage Brokerage Account, then change the account type to Margin Account. The change will take up to 2 business days to complete. After that, you will then need to head over to Menu, look for the Moneyboo promo at the Promotion Center, then tap Participate Now to activate the promo. Once that is done, head over to Markets, tap on the Moneyboo icon near the top, then make sure it's activated. What this does is that Weeboo will automatically invest all your idle cash into Moneyboo. But if you want to retain some amount as cash, you can also set an amount to let Weeboo know. After that, you can deposit money into your account and deposit as many times as you like. But just make sure that all deposits must be completed by 31st January 4 PM. And depending on how much you deposited and how long you keep your money in there for, you will either qualify for a cash voucher of $80 or $3,000. Take note that you don't have to keep all your deposited funds into Moneyboo to qualify for this promo. You can still invest your money into stocks and still be eligible for the promo. But just make sure that you do not withdraw any money during this period. Otherwise, it will reduce your cumulative deposit and you might not get your rewards. Besides the Moneyboo promo, Weeboo is also currently running a few other promos. If you sign up using my link down below, subscribe to at least $500 in Moneyboo. If you sign up using my link down below, subscribe at least $500 in Moneyboo and keep the money there for 30 days, you will win 25 free shares worth anywhere between $3 to $500 each. Besides that, Weeboo also launched a new transfer promo, from which you could possibly get up to $2,000 worth of free shares or more by fulfilling the requirements. So if you are interested in trying out Weeboo, do sign up with them using my link down below. With that being said, let's get back to the video. But then, could it be different this time? After all, there are some periods where after hitting all-time highs, the market starts crashing back down afterwards. So let's take a look at how are things doing now. So inflation has been steadily trending downwards. The US GDP growth rate is doing better now as compared to the previous 2 years. Unemployment rate remains low and the job market still remains strong. Meanwhile, the Fed is planning to cut interest rates soon. All this shows that the economy is in a pretty good shape and the Fed may actually achieve its soft landing goal. Then, what about the companies? Are they still doing well? Other than Tesla, of course. In the short term, analysts are expecting that the S&P 500 net profit margin to go down in Q4 2023. But over the next 1 to 2 years, S&P 500 earnings per share are expected to continue going up. So with everything currently doing well, if you were to sell at all-time high and wait for a drop to buy back in, chances are the market will continue going up and you might end up buying back at a higher price. But what about the S&P 500 being overvalued, or the yield curve inversion which shows that we might see a recession soon, or the analysts warning that the market could crash this year? Shh! Obviously, anything can still happen. The inflation could go back up, some country might just start another war, or another pandemic could just happen again. Heck, some president may just fall down and the market could just crash. But I think as investors, sometimes all we need to do is just take a step back, zoom out the chart a little, and see that the S&P 500 has been doing rather well over the long term. Sure, there will always be a crash here and there, but given enough time, it will eventually go back up. But why is that the case? The answer is simple. When you are investing in the S&P 500, you are not just investing in some random ticker symbol, Instead, you are investing in some of the best companies in the world. So what you're betting on is that these companies' CEOs and their employees know what they are doing, and they are always coming out with better and smarter ways to do things, and as a result, their businesses will improve over time, and that will cause the stocks to go up. That's what you are betting on. And as investors, we need to remind ourselves that, hey, sometimes we don't know enough to pick the winners, we don't know enough to predict when will the market crash and when will the market go up. But what we do know is that as long as we invest in something that's relatively safe, like the S&P 500 index or the all world index, market up, you buy, market down, you cry a bit, then you buy more, and over the long term, you should do well. So don't keep spending your time thinking how to in out of the market every day. These are the things that you can't control. Instead, just consistently buy into the market and trust the process. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.